Hi, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 135, titled Converting High Volatility ETFs to Conservative Cash Generating Positions. We're going to be using a real life example today with Global X Lithium and Battery Tech ETF, which trades on the New York Stock Exchange under the ticker symbol LIT. Now, most of you know that ETFs, generally speaking, have lower implied volatility than individual stocks. The reason is that they are baskets of stocks, with some going up and some going down. So if you take an average, the IV of ETFs, generally speaking, are lower than that of individual securities. However, there are exceptions. Question is, can we convert these high IV ETFs that are elite performing at the time into lower risk trades? And of course, the answer is yes. Otherwise, I wouldn't be making this podcast. So let's evaluate this dilemma now. When we use our covered call writing and put selling premiums, we know that they are directly related to the implied volatility of that underlying security. So a high V IV underlying security will generally result in very juicy premiums. However, they also, along with that, have greater risk to the downside, and that's what we're going to try to mitigate. Now, the relationship between IV and premiums hold true for both individual stocks and for ETFs. We're focusing in on this particular ETF in this podcast. So how do we manage these elite performing securities that generate such high returns for near the money strikes? Can we use them and yet still mitigate the risk of this high implied volatility? Of course, the answer is yes. So let's have a look at one of our premium member ETF reports from 2021, which shows where the top blue arrow is an implied volatility of the S&P 500 at that point in time of 18.35%. Now, in comparison, for those of you who are also watching this podcast, you could see that some of the securities had implied volatilities over 70%, like PBW and ICLN, for example. But let's focus in on LIT, the security that we're going to be referencing in this particular podcast. And we see here now that at the time I made this screenshot, LIT was trading at 69.93. When I went to the options chain, as you'll see in a moment, it was just a little bit less than that. But at that time, the IV was 56.92. It was more than triple that of the S&P 500. So once again, juicy premiums, greater risk. What can we do to mitigate? Let's look at an option chain now for LIT and look for deep in the money strike prices that will give us both a decent return as well as increased downside protection. Now, at the time that I made this screenshot, LIT was trading at 68.30. So we're going to look at the 61 deep in the money strike that had a bid price of $8.70 per share, or $870 for the contract. Now let's feed this into the multiple tab of one of the BCI calculators for covered call writing, and we see the stock price was at 68.30, and the 61 strike had a premium of $8.70. Now the spreadsheet will give us some very interesting information. First of all, the 1 month return on the time value aspect of that premium is 2.3%. So if we annualize that out, it would annualize out to about 27%. That's pretty good. Now, there's no upside potential within the money strikes because we're agreeing to sell our shares at a price lower than current market value, $61 a share in this case, with LIT trading at 68.30. But look at the downside protection. Those of you not watching this podcast, I'm going to tell you, it's 10.7%. Now, what that means is we are guaranteed a 2.3% 1-month return, as long as share value does not decline by more than 10.7% in that 1-month contract. So we have all of this additional downside protection by using this deep in the money call strike. And because it's such a high implied volatility security, we still have a very significant 1-month return of 2.3%. Now, what about the break even? Well, the break even price point is down to $59.60, and that's from a current market value of $68.30. So very significant protection to the downside, and yet still very significant time value return on this 1-month trade. So let's summarize now. Mastering the 3 required skills for option selling will give us the ability to convert these potentially risky trades to more defensive position while still generating significant, in this case 2.3%, 1-month time value returns. In the case of LIT, we use the deep in the money call strike to position ourselves favorably in both areas, in terms of our 1-month return and in terms of our downside protection. So we have the opportunity to use this elite performing security that arguably has one of the highest IVs of all the shares on our list, but yet we can convert it to a lower risk trade by using the deep in the money strike. Before I go, I just want to remind everybody about our BCI package, which is our best and most comprehensive educational product ever offered by the blue collar investor. It has 18 components to it, 6 online video courses with downloadable workbooks, 6 calculators invented by the blue collar investor and therefore found nowhere else, 5 of our best-selling books in ebook format, and our annual premium membership, which is 13 months of membership, which contains our reports, 4 reports that we provide to our members, 2 weekly, 1 monthly, 1 quarterly, as well as an online training video section of over 200 training videos and much, much more. So that's all part of the BCI package. Just go to our website, www.thebluecollarinvestor.com, and click on the link BCI package for more information. We also have in the Blue Collar store an area where you can purchase these items individually. So ladies and gentlemen, I want to thank you for taking the time to listen to and or watch this BCI podcast number 135, Converting High Volatility ETFs to Conservative Cash Generating Position. Folks, I hope you enjoyed this presentation, and more importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.